Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 3. This is Section E1. This is an application topic. Recalculate and reperform procedures to validate the inputs and assumptions of an entity's significant accounting estimates with a higher risk of material misstatement or complexity, such as fair value estimates. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it's free, it is 1 hour long, and we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. So make sure you check that out. After you check that out, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. Pro members get access to the full 10-question versions of these videos. In today's video, we're only going to be going over 5 questions on YouTube, but again, SuperfastCPA Pro members get access to the full 10-question versions of the videos so that they can get a little bit more practice and a little bit more understanding. So make sure you check out the webinar, check out becoming a pro member. With all that, let's dive straight into the questions. All right, here we are at question 1. Let's just dive straight in. Which of the following best describes a significant accounting estimate in the context of an audit? So let's go through the options. Option A, an estimate that is based on objective data and historical trends and is unlikely to change. Option B, an estimate involving low subjectivity and immaterial amounts that do not affect key financial statement line items. Option C, an estimate that requires management judgment or assumptions and could result in a material misstatement due to estimation uncertainty. Option D, an estimate that is reviewed annually but does not require auditor attention unless management changes the calculation method. So which one of these is something that best describes a significant accounting estimate in the context of an audit? Now, based on what I read, you might already kind of have an idea based on, your general knowledge, or some of the options might not sound as good as the other ones. So if you have a good guess, that's great. Let's go ahead and take a look at the answer together right now. Okay, here we are. The answer is C, an estimate that requires management judgment or assumptions and could result in a material misstatement due to estimation uncertainty. So that is going to be something that is considered a significant accounting estimate, and we'll kind of see that throughout the rest of this video. A significant accounting estimate typically involves complex calculations, subjectivity, or assumptions about future events, making it susceptible to management bias or error. These estimates may materially affect the financial statements and often include areas such as fair value measurements, impairment assessments, or warranty liabilities. Auditors focus more attention on these because they present a higher risk of material misstatement. So we learned there what a significant accounting estimate is. Now let's go to the next question. All right, here we are at question 2. Which of the following scenarios involves a significant accounting estimate that most likely presents a higher risk of material misstatement or complexity? So we're kind of going to try to apply what we just learned in the first question to see if we can apply it to a scenario here. So option A, estimating annual depreciation on vehicles using a 5-year straight line method with no residual value. Option B, estimating year-end accrued payroll based on hours worked during the last week of the year. Option C, estimating prepaid insurance expense based on invoices and coverage periods. Or option D, estimating the fair value of a privately held investment using a discounted cash flow model with unobservable inputs. Now, if I'm being totally honest, if you were paying attention to those, you probably already have an idea which answer is correct, but if you don't, that's okay, we're going to go through this. So which one of these is going to be a significant accounting estimate based on what we learned in the first question? Pause the video if you want to think about it. If not, let's go ahead and take a look at the answer right now. All right, here we are at the answer. D, estimating the fair value of a privately held investment using a discounted cash flow model with unobservable inputs. So let's go through the explanation. Again, this one probably makes a lot of sense. Fair value estimates involving unobservable inputs, such as level 3 inputs, often require significant judgment, complex modeling, and assumptions about future cash flows, discount rates, or market conditions. And remember, we learned about this in a previous video, so you might want to go look at the estimates video that I made previously. But level 3 inputs are basically, they don't have anything that matches them. There's nothing that you can observe in the market that kind of helps you know that the fair value is correct. So again, these are the kinds of estimates that would be a significant accounting estimate, and you would be very inclined to make sure you check on it and make sure that it's okay. This increases both the risk of material misstatement and the complexity of the estimate. Like I said, the other options involve relatively routine or straightforward calculations with low subjectivity and minimal estimation uncertainty. So again, the kinds of things that you're looking for when it comes to significant accounting estimates are the things that have a lot of management input. They're using things that are maybe unobservable, or, they're kind of making their own system to be able to create these estimates. Things like that are going to kind of raise a red flag for the auditor, or at least make the auditor want to verify those estimates more than other estimates. Now with that, let's go to the next question. Okay, here we are at question 3. Now, one thing I want to say about question 3, 4, and 5, I tried to kind of emulate a simulation with these next 3 questions because I think that most likely if you see something about this type of topic, there's a good chance that you're going to see it as a simulation on the exam. So I kind of wanted to, again, create a simulation type experience. We're still doing multiple choice questions, but I'm basically giving you the same scenario for the next 3 questions for 3, 4, and 5. But I'm going to ask you a different question about the scenario in each of the questions. So the information is going to be the same for the next 3 questions. So I'm probably going to read it here and then maybe just kind of refresh on the next 2 questions. But then the biggest thing will be the question will be different for each of them. And one more thing that I kind of want to point out as well, before we dive into question 3, a good strategy to have on test day is to read the last sentence of a question first. So I typically try to bold that in my videos because you want to read the last part of the question first because that will give you context for what the question is about. Imagine you saw something like this on test day, kind of a big, ugly looking question, and you start reading from the top and, that's okay. But if you read the last part of the question first, frequently that will give you kind of an idea what the question is even about so that you can be looking for what you need to get the correct answer as you're reading through the question. So again, it's just kind of a strategy to be a little bit quicker on test day, reading the last sentence first to get that context. So let's do that here. Based on company policy, is the reserve for basic licenses accurate? If not, by how much is it misstated? Let's go up to the top. You are auditing Advanced Tech Corp, which sells 3 types of software licenses: Basic, Pro, and Enterprise. The company records a sales returns reserve each quarter based on a percentage of quarterly sales by product line, as outlined in its documented policy. And so for Basic, it's 3%, for Pro, it's 5%, for Enterprise, it's 8%. Advanced Tech provided you the following data for quarter 4. The basic sales were $1,200,000, and the basic reserve was $36,000. The Pro sales were $800,000, and the Pro reserve was $16,000. And the enterprise sales were $1 million, and the enterprise reserve was $88,000. And remember, this information that I just read through is going to be the same information for question 3, 4, and 5. But the question here is based on that company policy that we just learned about. Is the reserve for basic licenses accurate? And if not, how much is it misstated by? So option A, the basic reserve is overstated by $4,000. Option B, the basic reserve is understated by $2,000. Option C, the basic reserve is correct. Or option D, the basic reserve is understated by $4,000. Now, I think that just kind of based on the fact that this is kind of focused around math and it's not super complicated math, you could probably pause the video and kind of calculate your way through this and try to get the correct answer. So I would recommend doing that. Pause the video, do this on your own, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer. C, the basic reserve is correct. So this really wasn't too difficult. Again, it's kind of a big, ugly looking question, but the only thing you needed to do here was calculate if the basic reserve was correct or not. The expected reserve for the basic was $1,200,000 multiplied by 3%, and that should be $36,000. We go up here and look at the basic reserve that they recorded, and it is $36,000. So that's pretty much exactly what the auditor would expect to see. So there doesn't seem to be any misstatement there. So everything looks okay. So that's an estimate that the auditor was checking because it is a significant estimate, and if something was wrong, it could be materially misstating in the financial statements. But everything looks okay. So now we're going to move on to the next question, again, in the same scenario, but we're going to ask a different question. So let's go to question 4. Okay, here we are at question 4. So again, same scenario, exactly the same. So there's still Basic, Pro, and Enterprise. 3% reserve for Basic, 5% reserve for Pro, and 8% reserve for Enterprise. At least that's the policy. And then, the basic sales, $1,200,000, basic reserve, $36,000, Pro sales, $800,000, Pro reserve, $16,000, Enterprise sales, $1 million, Enterprise reserve, $88,000. So again, all the same information. Which of the following best explains the issue with the reserve for Pro licenses? So is there an issue with the reserve for Pro licenses? You might have to think about that, but let's go through the options really quick. Option A, the client mistakenly applied a 2% return rate instead of the 5% policy. Option B, the client correctly applied the policy but used the wrong sales number. Option C, the client applied the 5% rate but spread the reserve evenly across 2 quarters. Or option D, there is no issue with the Pro reserve. So I think you could do this again. It's not too difficult, but this is the kind of thing where you have to kind of read through it and make sure you are looking at the right stuff and understanding what you're supposed to be doing. Check if the Pro reserve is right and think about why you think it would be incorrect. And when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is A, the client mistakenly applied a 2% return rate instead of the 5% policy. That's the most likely thing based on what we're seeing here. It could technically be based off the wrong sales number, but that's, we aren't really given any other number. So it's much easier to assume that it's this 2% because we can calculate it very easily. Let's take a look. The expected reserve for the Pro was $800,000 multiplied by 5%. So that gives you $40,000. So that was the expected reserve for the Pro. But the client recorded only $16,000, so that means that they most likely multiplied $800,000 by 2% instead of 5%. And that could have just been a calculation error or whatever the case is, but this indicates a rate error, not a timing or an input issue, or maybe it is an input issue if they put in the wrong rate. But at any rate, that is the most likely error from what we're seeing right here. So again, it looks like they applied the incorrect percentage. That's something that the auditor would want to pay attention to and kind of point out like, hey, you didn't use the right number for the pro reserve. And a $24,000 misstatement could be material depending on the audit. So that's important to know. Now let's go to the next question, again with the same information, but with a new question. All right, here we are at question 5. Again, same information. You've been looking at this for 2 questions now. So I'm just going to go straight to the question. The reserve for enterprise license appears higher than expected. Which of the following is the most likely explanation? So, we've checked the basic, we've checked the pro, now we're checking enterprise. It appears to be higher than it should, and you can calculate that really easily, and you'll be able to see that it's a little bit higher than it should be. So let's read through the options and think about why it would probably be incorrect. Option A, the client incorrectly applied a 10% return rate for enterprise licenses. Option B, the client inadvertently included some quarter 3 or quarter 1 sales, maybe quarter 1 in the next year, in the quarter 4 calculation, so it could be a cutoff error. Option C, the client included reserve amounts for both enterprise and pro licenses together. Or option D, the client applied the correct rate but rounded up excessively. So kind of look at what the enterprise reserve should be and what it actually is, and kind of compare that and think about these different options and which one would be the most likely based on these different options that are presented. And when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is B. The client inadvertently included some quarter 3 or quarter 1 sales in the quarter 4 calculation, so it would be a cutoff error. Again, you could probably argue that it was maybe something else, but if you did the calculation, you could easily tell that option A, not going to make sense. Option C, not going to make sense. And then option D, really, there's nothing here to prove that that's what happened. So option B is the most likely because, it would be easy for them to accidentally include an additional $100,000 in sales from quarter 3 or quarter 1 compared to just rounding up excessively, that doesn't make as much sense. Let's go through the explanation. Based on the company's 8% policy, the expected quarter 4 reserve for enterprise licenses is $1 million multiplied by 8%, $80,000. So that's what the auditor is expecting. The actual recorded amount is $88,000, resulting in an $8,000 overstatement. This difference would be consistent with Advanced Tech having used maybe an extra $100,000 of sales in the enterprise base. And the most likely thing that could come from would be something from, would be sales from maybe an adjacent quarter. Maybe they accidentally included $100,000 of sales from the quarter 3 or maybe quarter 1 of the next year. And so that would be a cutoff or a timing error, and that would affect the estimate and make it potentially material misstated. Again, depends on the situation, but an $8,000 misstatement, depending on the audit, could be a material misstatement if the auditor has a really high risk of material misstatement that they've figured out. So with that, we've gone through 5 questions in this video, and we've kind of tried to emulate a sim a little bit. I hope that this was helpful to kind of help you learn kind of what you might be seeing on test day. Before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up in the questions. Maybe you don't see too many multiple choice questions about something, but you see this topic more focused on in a sim or whatever the case is. You notice these things throughout the questions, and you notice what is most important and what is being taught in those questions, and you write them out in your own words as the pillar topics, the most important things that you learned from the questions. And as you're doing this each day, you're building your own personal repository of the most important things you need to know for the exam based on the questions that you went through in your review course. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, what makes an estimate significant? An estimate is significant when it involves judgment, assumption, or has a material impact on the financial statements. These factors increase audit risk due to subjectivity and uncertainty. Now let's talk about the complexity that increases audit risk. Estimates using unobservable inputs or complex models, like discounted cash flows, carry a higher risk. And so, therefore, these would require closer audit scrutiny because of the greater potential for error or bias. So these are the kinds of estimates that we were talking about in this video. We're talking about estimates that could have material impact or that involve a lot of judgment or things like that. That's the kind of estimates that the auditor is going to try to focus on. Now let's talk about recalculation tests for accuracy and policy. Auditors recalculate estimates to confirm they align with company policy and math is correct. And we kind of did that in these questions. Differences must be evaluated to determine if they are justified or misstated. Now let's talk about policy misapplication, and that leads to errors. Using the wrong rate, formula, or data point can cause a material misstatement. Auditors must check that estimates are prepared according to approved methods. So if the client says that they have a policy for doing the estimate, but then they don't actually follow that policy, that's probably going to lead to errors and they could be material. So the auditor needs to make sure that they're actually following the approved and the client methods that are in the policies. And then finally, let's talk about the timing matters in estimates. That's kind of what we talked about in the last question. Including data from the wrong period, like prior quarter sales, can misstate estimates. If you're using too much or too little or using the wrong data for your estimate, of course, it's going to be wrong. Auditors must verify that inputs reflect only the correct reporting period or the correct amounts or things like that. Now with that, we learned a lot in just 5 questions and in the pillar topics. Again, in this video, we're only going to be going over 5 questions because this is the YouTube version, but Superfast CPA Pro members are going to get access to the full 10-question version of the video when we post it in the members forum. So if you like this and you like our other products, make sure you check out becoming a Superfast CPA Pro member because you will get access to not just the Pro course where Nate explains in detail exactly what you're supposed to be doing every day, but you will also get access to the full versions of these multiple choice question walkthrough videos to get a little bit more help and a little bit more understanding. Now, the easiest way to become a Pro member is actually to go to superfastcpa.com and sign up for our free 1-hour webinar training, because once you watch that 1-hour webinar training, you're going to learn a lot more about Superfast CPA and it will give you a good path to then becoming a Superfast CPA Pro member. So check that out as well. Now with that, I hope you liked the video. If you did, make sure to like it and leave a comment. I hope this video was helpful and I will see you in the next one.